Hello and welcome to With Wellner Anderson. This is the channel where we talk about economic, financial, and we talk about financial and we talk about business things in simple terms. Once a month we talk about how things are going right now. In this video essay, if you hang on till the end, you're gonna understand when the economists use certain terms. You should understand what those terms are and be able to interpret that, because what I'm going to do is take their terms and I'm going to say it in simple, plain English. We are in recession. The actual physical definition of recession is 2 quarters of negative gross domestic product. So what is gross domestic product? Gross domestic product is the annual amount of finished goods and services produced in a year, less the amount of imports. It's a lot, but let me break that down for you. If you produce a car, if you build a house, that becomes part of the gross domestic product. If it's a used car or a used house that was built years before it was sold in that year, it doesn't count. Let's talk about a couple of the signs of recession. The wages may go lower. That's not the case today. We have wages going up. This is unusual, guys. Credit tightening, that is happening. Unemployment rising, it's happening now. The last report in April was 3.7. We're going to get to that also. Slowing in new housing, that is happening. Housing starts beginning to slow and drop. That is happening. More renters than buyers. Yes. Credit costs have begun to increase, and part-time workers are going back to work. So there may be some issue with full-time jobs. There is corporate downsizing. The stock market is dropping a little, bond rates are rising, and there is potential for deflation maybe down the road. We are in recession. This is September 4th, 2023 for your records. Let's try to talk about the terms that the financial people use when they assess a recession. They use something. You have to first of all understand what is a central bank. And in the United States, the central bank is called the Fed. And let me explain to you some of their roles that they're going to play a little bit later on in this video essay. But let's talk specifically about some tools. One of the tools the economists use is called the federal funds rate. Now, the federal funds rate is an amount that the banks charge their best customers. And the best customer of a bank is a bank. So in order for a bank to open in the morning, they have to have reserves. And the federal funds rate is one bank lending another bank money, so when they open up in the morning, they can service their customers. Those are the best possible banks. They get the best rates. You can think of what would happen if you ever saw the movie in 1943, It's a Wonderful Life, where I think the man, it's played by Jimmy Stewart. He is in the bank and people are rushing in the bank trying to get their money really quick. And he plays George Bailey. And the money that's in that bank would be called what would be reserves. Now, I said I talk about central banks. It's important to understand that because the central bank is the lender of last resort. It also controls the money supply, and the United States is not a government agency. It manages the banking system and sets the interest rates by a meeting that it goes through once every 6 weeks called the Federal Open Markets Commission. And the federal funds rate right now, at least in July, was 2.50. It's gone up another 75, they call it basis points, so it's 3.25. When rates go up, when they raise rates, that tightens the money that's available. The stock market, we use the Standard & Poor's 500 as a monitor because of all of the stock markets. The Standard & Poor's 500 has the broadest amount of stocks, and it's since August 14th it was at 4,280. It has dropped to 4,006. So the Standard & Poor's is dropping also, maybe a negative sign. We also look at something called the ISM PMI. Don't shut me out now. The ISM PCI is called it's not important to understand what it's called, but I'm going to say it. The Institute of Supply Managers Purchasing Managers Index. But it's important that you understand what they do. What they do is they're an agency that's polled. They're a bunch of purchasing managers. They are asked what do their sales look like 6 months down the line? What does employment look like? What does inventory look like? What does sales look like? What does marketing, what do expenses look like? That gives the economists a flavor for what these people are going to be buying in the future. It's 6 months down the line. So that's very important. So another interesting thing economists use is called the yield curve. And what they're looking for is called a yield curve inversion. I want to take you back to old high school math days, but if you think of a plot with a whole bunch of blips on the plot and you draw a line through the plot, there are two aspects the economists look at. They look at the plot for 2 years and they look at the plot for 10 years. If people are willing to pay more money to keep their money in a bond for 2 years than they are for 10 years, that signals to the economists that people don't have confidence in the market in the long term. So in other words, to make it simple, what's happening is people are investing in a property that gives you a higher return in 2 years than it would in 10 years. That is usually the opposite, because the longer you tie your money up, the greater the risk is in the money, so you should get paid more. That is a giant flag with the economists, and it's the yield curve has been inverted on and off for the last few months. That's a bad sign. Let me give you some tidbits of news. Again, it's 9/4/2022. Again, if you're getting benefit out of this, give me a like, give me a thumbs up, and let's go through some tidbits of news. There was a $3 billion student loan forgiveness program that was signed into order. The passage of the Inflation Reduction Act. Housing prices are beginning to drop as interest rates rise. Credit card debt is now an all-time high. Unemployment rose last month to 3.75 from 3.50. It's expected that Russia may be closing the oil and gas pipes to Europe this summer, so that's something to be concerned with. China is continuing its lockdowns. This is the third consecutive week of stock market losses. Wages continue to climb. And as I said, the Federal Reserve raised the federal funds rate. Again, thank you for watching. If you have value in this, definitely give me a thumbs up and definitely subscribe. It's going to be once a month or once every 3 weeks, so make sure you subscribe so you don't miss anything. Thanks and have a great day.